Welcome to Your Retirement Playbook. I'm your host, Joe Clark. Happy to have you along. Actually thrilled that you're taking the time to learn more about your retirement playbook, things that are going on in your life. And this really is about you. We're trying to give you things on this show that you need to consider that we think are valuable and important for the more than 1,100 families we take care of in more than 30 states across the United States. So I'm going to walk you through the way that I think about money and give you some things to think about. Now, if I was going to summarize the risk or what you're going to get out of this segment, it would be this. I love, maybe an analogy is a better answer. I love cooking for friends and family. I just do. I enjoy it. I've been to a few cooking schools, and some of you may go, oh, that means you're great. Nah, not necessarily. Going to cooking schools is one thing. There's a difference between knowledge and wisdom, right? Knowledge is the information. Wisdom is how to apply it. I will assure you in a cooking school, you can put two cooks together and come out with two entirely different dishes if one of them has better wisdom on when to add the onions or when to add the oil or when to add the salt to the terminology. But anyhow, I love cooking for friends and family, but it fascinates me the number of people I watch who have a fear over cooking and yet an absolute confidence over managing their investments. What if I do it wrong? What if I burn something? Folks, you get one shot at retirement. I can order Pizza King, right? I mean, I can pick up the phone call and I can call and order pizza. If the dish is burnt, you may have a stinky house. We'll eat outside, right? But you only get one shot at retirement. Please don't blow it. We are in very, very volatile, very, very changing times. It is very, very complex. And we want to help you make the best decisions you possibly can. Now, we are fiduciaries at the Financial Enhancement Group. That means I get paid to treat your money as if it were our money and we were in the same situation. Last week, we talked about character trust and competency trust. And I get it. You care more about your money and you trust you more than you're probably going to trust me and more than I care about your money. That is probably a fair and accurate statement. Some of my families would argue and say I care more, but we won't even go there. For this minute, let's just use this theory. You trust you more than you trust me, and you care about your money more than I'm going to care about it. Possibly, probably. But let's go to the competency side. And that's where you really have to have the ability to do things with the finances that make the most sense within those 5 critical elements we talk about all the time. Your life after work, the annual tax plan, the weekly investment playbook, the life happens, the good and bad and ugly of life, and last but not least, the legacy plan. And how do you bring that all together with all those decisions that operate? Right, so what we try to do on this show is to give you as much of that competency as we can. At the end of the day, we're hoping that you call us at yourlifeafterwork.com or 800-928-4001, but we want to give you that knowledge and that information. What I'm going to try to do is to walk you through my decision-making process so that you can understand it. So let's go to my favorite menu, not to my favorite place to eat. People laugh and go, how often do you eat there? I don't think I've been to the Cheesecake Factory in 2 years, maybe 3. But I love the menu. There are 250 choices on a Cheesecake Factory menu. 250 choices. How in the world do you narrow that down? And the answer is some people would do it by the style. Some people like Italian more than the Louisiana or Creole, or more than Indian, or more than good old-fashioned American hamburgers and hot dogs, right? Some people would do it by style. Some people do it by ingredient. They like pork more than chicken. They like beef more than fish, right? Pretty easy to do. Spice is obviously one of those, so we'll stay away from the curry if we don't like the spicy stuff and go towards something that's a little more bland, depending on your dietary restrictions and where you are. Some people do it based on whether they're vegetarians or vegans or whether they're carnivores, right? And they want as much meat as they can possibly get. The point is you have a process in place. You don't look at 250 things and have to start with 250 and go from there. You've got a filter that knocks those down. So in the world of finance, what are those filters? Well, I've got it down to 4 that clarify all of my messages. And sometimes people think I'm over anal about this, But I make sure that something is answered in each one of these 4 areas before I make an investment decision. The first one is risk and volatility. Risk is that I don't get my money back at all, right? I put the money in, the company went under. It didn't have no survivability at all. It was gone. Volatility is that the price was different at independent times. That's what the market does. We all know historically the market goes higher over an extended period of time with a lot of upsies and downsies in between, right? That is just the truth of the matter. We can go all the way back into the pandemic. There's still rarely a day after March of 2020 that you wouldn't have wanted to have been invested in the market today. The market is still higher than it was then, even though it's had deterioration here in 2022. This is recorded in case you're listening to it into the future. So over an extended period of time, the market does tend to work itself higher. It has historically, at least in a diversified portfolio. But short term, I may need my money out and the market may be down. So that's a big deal in distribution or retirement planning that you have to pay attention to. So the first one is risk and volatility. One question. The second one are fees and expenses. Jerry Maguire had this right years and years ago. Show me the money, right? How is the other side of the deal getting paid? I do not mind paying people at all. I will use as much service industry as I possibly can. But I want to know how they're being compensated to make sure that it's being fair and I'm getting what I'm paying for and that I'm paying for what I need, right? Those are different things if you think about it. Am I paying for what I need and am I getting what I'm paying for? And am I paying a fair price? You really have to break all of that down and understand it. A lot of what happens in the compensation on Wall Street is stealth. It's flat out hidden. And people don't see the fees and expenses that they spend inside of mutual funds where they could easily save themselves the fee in many cases that they would pay us as a fiduciary to manage their money. They're given to somebody who's not helping them, that they're not going to meet and aren't going to meet. It's a very, very interesting thing, but we have all those comparisons we can sit down and show you. So risk and volatility, fees and expenses. The third one is taxes. But here's the key. It's taxes both today and tomorrow. Nobody wants to pay more taxes today. But I will assure you the strength of your financial plan is built upon paying less taxes over an extended period of time, or what I like to call your financial journey. So it's tax planning both today and tomorrow. And last but not least, people have laughed at me for the last 8 years as I've talked about this because inflation has been almost zero. Inflation is a sleeping giant. And when it roars, as you're seeing today, it is really roaring. It's real return. That's the fourth thing. How is my purchasing power going to be impacted by the financial decisions that I'm getting ready to make today? Is this going to do well with inflation, poorly with inflation? So risk and volatility, fees and expenses, taxes today and tomorrow, and real return. Then I'm going to move to the family focus process. That's our trademarked process that we have internally. But I'm going to do all of those things within the guidelines of those 4 things that I call the fiduciary focus. Risk and volatility, fees, expenses, taxes today and tomorrow, and real return. I'll remind you, James Clear, author of Atomic Habits, said that success is never dependent upon one thing, but failure can be. Your financial journey, in my opinion, is based on the success of 5 areas. Your life after work, that's your retirement planning, your annual tax plan, the investment playbook, how you deal with short-term volatility in the marketplace. Third is the things that happen in life, good, bad, and ugly, along the way. And last but not least is when you're gone, who gets it and how do they get it? How easy is that done? And it starts with your financial vision. So we help orchestrate or coordinate, if you will, your financial vision between you and your significant others to make sure that you're on the same page. Not real long, a brief statement that says, here's who you are, here's where you want to go. Hopefully not quantitative, meaning there's no numbers. Qualitative, I want to, this is the life that I want to be able to live so that we make sure that we're on the same page. Then from there, you begin to deal with those 5 critical elements that we just talked about. Now, last but not least, the third thing in my thought process, my filter, my decision making, is I want to control what I can control. I can control the amount of money that I contribute. I can control the amount of money that I do in tax distribution, for instance. The amount of withholding if I'm putting money in, whether I want it to be Roth or whether I want it to be tax deferred. I can control the amount of money that's going into various plans up to the limit that the IRS provides, right? So there is some control that I have there. What I can't control is the annual return. The shorter the window, the less I can control it. The longer term, the more accurate my projections will be, as long as, again, if you're in preservation, you're there beginning, middle, and end. And I can't control inflation. Now, that one's argumentative to me. I believe we have different inflation rates. My inflation rate is probably higher than most of yours. I love travel, which is going up, and I use an awful lot of services. I don't enjoy some of the stuff that happens around the house. You probably do. You may. A lot of our families like that outdoor work. I don't. I would rather go to work, do this for you, and pay somebody else to do the mowing and the landscaping and those kind of things. Inflation in the services sector is going to be higher than inflation in the goods sector. But regardless, you need a checklist for your decision making that you can go down. I love golf. You watched the golf show I did a few weeks ago. I almost left the battery charger for my powered cart at home yesterday morning when I got ready to go out to go golf because I didn't have a checklist. Now, I didn't forget it, and I do have a checklist now to make sure that I don't forget something that basic. If I could forget something that basic, what are you forgetting about retirement planning? Make sure that you've got risk volatility, fees and expenses, taxes today and tomorrow, real return. Break it down into retirement, tax, investment, the oopsies and the goodsies of life, and the legacy, the estate planning side. Make sure you've addressed all those. Control what it is you can control, or better yet, give us a call at the Financial Enhancement Group at 800-928-4001 or go to yourlifeafterwork.com. Get signed up for a Next Steps meeting. We'll give you 90 minutes complimentary. yourlifeafterwork.com. We'll see you soon. What's your next step? Well, ours at the Financial Enhancement Group is to sit down with you, give you 90 minutes of our time complimentary. You bring in your tax return, your legacy documents, your investment stuff. We'll give you our best thoughts of things that you need to consider today, things you're going to want to consider in the future, and if we choose to partner together, what FEG will do for you, and we'll put it into writing. Again, that's your Next Steps meeting. That's what you ought to do. That's what we want you to do. And that's what we're willing to provide for you. We take care of people just like you who are beginning to enter that stage of retirement, separating from the workforce, or what we like to call yourlifeafterwork.com. Give us a call at 800-928-4001 or go to yourlifeafterwork.com. Get signed up for your Next Steps meeting today. Welcome back to Your Retirement Playbook. I'm your host, Joe Clark. Happy to have you along. We are talking about the end game now. What does it look like when you've come to reach the end of your working period of time, you're getting ready to separate from the workforce, and you're talking about your life after work? Now, I'm going to be very, very transparent. I have no intentions of retiring until my mind can no longer do what it is that I do. My body gives out, my head gives out, or God calls me home. I will probably do this. So I don't want anybody saying pot and kettle. That's not my point. I wake up every day and I'm thrilled with what it is I get to do for a living. You guys allowed me to do that, and I can never thank you enough for that. But for those of you who want to leave the workforce, here's what it is you need to think about. And it's really true for those of us who don't want to separate from the workforce. Now, my friend Ed Slott probably puts this as well as anybody when you talk about the end game. He reminds us it doesn't matter who won the first half. It doesn't even matter who won the third quarter of the football game. It's how you finish the game and the final score that counts. Now, here's the interesting part. We talk about for years and years and years in retirement, somebody working 30, maybe 40 years, right? If you started at 20 and you retired at 60, you got 40 years. If you started at 25 and ended at 65, you've got 40 years. But if you get to 65, how long does retirement last? And that's really when you get into that life expectancy conversation. And this is something that is very misunderstood. Ben Franklin, Thomas Jefferson, our heroes, since we just left the 4th of July weekend, our patriotic heroes. were not in their 40s and 50s and 60s and even 70s when they passed away. They were in their 80s. There were quite a few people who were in their 80s back in that period of time. We went down once upon a time to Key West for spring break vacation. It fell over Easter. I took the kids to a church. The windows were all donated. This was probably in 2003, 4, somewhere in that period of time. The windows were all decorated, or the stained glass windows were provided for by people who were all over 95 years old, who died in 1901, 1902, 1903. We've been living an extended period of time for a long time. What's happening with life expectancy is we've eradicated, to a large degree, infancy death. You know, it's still there, sadly enough, for families that have that, but we've gotten rid of that. We can, we've, it's amazing. I almost slipped and said something about one of our foster kids, but that my daughter has. The reality is that we've been able to do life-saving measures for babies. We've been able to take care of young people. We've gotten through the war stages. We're living longer overall, not necessarily living a lot longer as individuals. So this becomes a very, very important part in terms of that retirement understanding and knowledge of how long you will live and how long you need to have your money so that you know how much you can actually take out. It also helps the Social Security conversation. So the first question, if you're going to win this, the end game, you're separating from workforce and you're getting ready to go into that next stage, is how much can you take? Well, the first question, and I think people get this backwards, it's not how much can you take. The first question is how much you need, right? How much do you need to maintain the standard of living to which you become accustomed, or the one you want to become accustomed to? See, people still believe that retirement is really based on a replacement of income. It is not. It is based on a replacement of your standard of living. So if you make $200,000 a year, and you're contributing to your 401k, and your spouse is contributing to their 401k, that's over 50 grand, right? Maybe not you're contributing to the Roth. That could be another 14 grand if you're putting it into it. Then you've got Social Security tax that's on top of that. You're likely, if you were making 200 and you're saving your retirement plans, you're likely living on $120,000 a year, not 200. So in order for that to be able to be replaced, you've got to replace the 120, not the 200. Right, so understand, and that's where that retirement budget comes into place, and we'll help you with that at the Financial Enhancement Group in a Next Steps meeting. But when you look at that, understand what it takes to replace your standard of living, right? And then we have a number that we can take. Now, the higher the percentage you take out of the assets that you have, the more risk that you have of running out of money sooner than you expected or having to deal with market volatility. The younger you are, therefore, the lower the percentage you should plan on taking. So we tell somebody who is around 62 to 64 years old to expect to take about 3.8% of their income right now. And that, again, is in a diversified, properly managed portfolio. That's not out of a bank account. That's not out of the S&P 500 index. That's our number that we use based on what's managed. The older you are, the number that number can rise slightly. The younger you are, the more it ought to go down because you have more opportunities or more exposure to negative market volatility over the course of your lifetime. Again, one of the mistakes that happens when people don't deal with fiduciaries is they talk to brokers, people who haven't done this for very long, or even who have done it for a long time, but haven't done it professionally in terms of retirement planning or distribution planning. If you've averaged 8%, of course you can take 5%. No, you can't. No, you can't. If you do that, market volatility will destroy your retirement. And remember, you get one shot at retirement. It's not like cooking, where if you screw it up, you can order Pizza King. If you mess up your retirement plan, you only get one shot at it. Make sure that you've got the most amount of competency working in that room, wisdom, experience, and guidance as possible to help you get to that next stage. So how much can you take? The real question ought to be, how much do you need? And then what do we do to be able to supplement it? And this is where we're able to fine-tune Social Security, your tax rate, things of that nature to be able to accommodate making sure you get what you need. There are a lot of people who start in a period of time where they're taking out a much larger percentage than what I just shared with you, But they're doing that knowing that they're going to have a retirement V for victory. If done correctly, what happens, and if you're watching this on YouTube, you're seeing the blackboard, the value of the account goes down, but they get to a period of time where Social Security can kick in, and you now have a retirement V for victory where the account's able to grow back up. That's the way it's supposed to be done. In a perfect world, that's what happens. The last 10 years, the market has actually gone higher even though people have taken distributions out. And it's been an unprecedented period of time, a large part, again, demographic driven. Part of it has been the quantitative and qualitative easing that we've seen in the marketplace from Federal Reserve. Part of it's low inflation, low interest rates. All of that combined created an unsustainable, if you will, type of market that has really confused some people and got them to make some retirement decisions they probably shouldn't make. You know, somebody says they've done something for 5 or 7 or 8 or 10 years, you would assume that there's a lot of experience there. Be very careful in our industry. You need somebody who's really been around for a while, who understands this, who's willing to tell you the hard facts. And that's that you can't necessarily take the amount of money that your average return has been, even when it's 15 and 20 years out. When can you start? It's question number 2. That's a good question. When can you separate from the workforce? I think everybody wants to have that opportunity to go tomorrow, just not necessarily take the action to do it. I want to know that financially, Barb and I are set. If something happened to me, or if something happened in my lives, I got a different calling for some reason, that we had the capacity financially to be able to go. So you want to know that. You know that by having a retirement budget put into place. What does it cost to maintain your standard of living? So I have a rough idea. It should probably be fixed clearer. I just have there's no part of me that really cares about doing this where I would go tomorrow or the next day. So it's an emergency for me. But I've got a rough idea of what it takes for Barb and I to be able to maintain our standard of living if I'm incapacitated and unable to work. You need to have the same thing. It does need to be divided between fixed expenditure and social expenditure. Fixed are the stuff that you need to be able to do at 55, 65, 75, 85, like eat, pay property taxes, pay utility bills rather. So it needs to grow up with inflation. You need to have that calculation in. But the social side is the desire to travel. It's the desire to go to football games, to kayak, to golf, whatever it is. Travel being the biggest of many people's budgets. You need to have that figured out in terms of where it is, and then know what it takes to replace your standard of living. That's the difference between the combination of your fixed and social expenditures. That'll give you an idea of what age. And remember, retirement is never age dependent. In my opinion, it is financial dependent. So can you retire at 35? Absolutely, if you have enough money. Can you retire at 75? Maybe not if you don't have enough money. How does it come out? This is one of our specialties. This is where we're able to come in and find tax efficiency. People look at average returns and statements. Ladies and gentlemen, the amount of money that you can pull out, understanding tax planning and proper distribution is far in excess, in my opinion, than what most people estimate it is. It is very difficult to put it into a quantitative, i.e. a percentage return of a portfolio, but that strategy, those distribution strategies of how much you can pull out and which account it should come out of, needs to look like a choir or a conductive orchestra, if you will. How to take money here and how to take money there and to be able to get it out in the most tax efficient manner possible. Remember that objective in distribution we talked about last week, right? The volatility between distribution points, and second was the tax rate of the average dollar that you pull out. Then question number 4 is when to make adjustments. This is critical to understand. When to make an adjustment is to understand that something has materially changed. I think when people make the statement that if you didn't sell, you didn't lose, it is an absolute mistake. Or that, it's time to go to cash, or, nothing good can happen from here. Remember, if you're going to go all the way to cash, the only thing that you can do is to put money back in when it feels worse than it does today, or you're buying in at a higher price. That makes no sense. But there are periods of time when you need to make adjustment. We have that system put together with our risk barometer, our proprietary investment decision. We do it internally. We do it with tax planning in mind. We follow that decision-making process that we laid out for you that says, here's how we think about things. The fiduciary focus, the family focus process, and know what we can control and know what we can't. Make good decisions, respond, don't react to craziness that is going on inside of the market. Again, respond, don't react with emotion and greed. Charitable gifting is not just an art and a passion that comes from within. In order to do it well, you really have to understand the United States tax code. You have to understand your portfolio. Yes, you have to have charitable intent, but let's be smart about the money. Go work with Financial Enhancement Group. Call 800-928-4001 or go to yourlifeafterwork.com. Get signed up for a Next Steps meeting. We will cover the better giver. It's not about how to give more. It's how to give more efficiently for your tax return. You get more. The charity gets more. The better giver. Call the Financial Enhancement Group, 800-928-4001 or go to yourlifeafterwork.com. Welcome to Your Retirement Playbook. I'm your host, Joe Clark. We are talking about what to do now in this crazy and volatile world. We're going to go into your final stretch using, that means actually decumulating or spending and gifting money out of your accounts. Now, you have probably always been charitable. Rarely do people wake up in their retired years and suddenly become charitable when they weren't before. If you are, God bless, that's a great thing. But usually this is something that goes on as you age and retire, and it becomes one of those questions that people get challenged with all the time. How much do you give at retirement? What about the market and the unknowns? How do I know I won't run out of money? There are lots of things to consider inside of charitable gifting. We're going to try to walk you through them right now. I will tell you, you can go to yourlifeafterwork.com, get signed up for a Next Steps meeting, and we'll go over the Better Giver program with you, where it's not our job to help you give more. It's just to give better, more efficiently, if you will, from a tax standpoint in terms of where we are. And one of the rules of charitable gifting, and this is one of the conundrums, if you will, is that people do tend to give out of income, not out of assets. So in the days of pensions and everything else, if you were used to giving 10% of your retirement or 10% of your income, and you retired and your income stayed at a certain level, or even if it was reduced, it was very natural to give 10% of that to the charity of your choice. One of the challenges that happens as people age now is the majority of their money is inside of 401ks or 403bs or what we call defined contribution plans, and people just aren't as apt to pull money out. They're not spending it because if they pull it out, they have to pay taxes on it. Nobody likes the IRS, right? Nobody wants to pay the taxes. And so people that were making $200,000 a year, that regularly gave $20,000 a year to their church, are suddenly only living on Social Security and maybe a small amount of money, maybe $50,000 a year. It happens many, many times. And now they're giving $5,000 a year to the church. They're wondering why their tax rate's not being more improved, and that's because there's an inefficiency in giving tax when you're not able to itemize from a tax standpoint. And secondly, the charity's wondering what they did wrong, and the answer is people give out of income, not out of assets. So you've got to educate yourself along the way, or the people that you work with that you're counting on for charitable contributions. So what do I do in an up market if I'm going to give money? Well, one of our concepts that we use is one that's called the double stack. And remember, less than 10% of us these days are able to itemize. If you do not itemize, you do not get a charitable tax deduction, period, right? You have to itemize to be able to do it. So 90% of us are going to take the standard deduction. We don't get any charitable deduction at all. Doesn't mean you shouldn't give, you just don't get a deduction for it. One of the things that we teach our people to do at the Financial Enhancement Group is to do a double stack, where we make 2 years worth of charitable contributions this year and none the next year. Yes, that works out just fine and may allow you to actually take advantage of itemized deductions, and then next year take the standard deduction. You're able to get, in some cases, a savings of $3,000 to $5,000 off of your taxes simply by doing it in the right period of time, understanding the way the tax rate works. So in upward markets, that's one of the strategies we are able to use. The second one is understanding the gifting of appreciated stock. When you gift appreciated stocks, You get a deduction for the fair market value, and you never have to pay taxes on the capital gain. Again, only if you itemize. That's a beautiful thing. If it's coming out of an IRA, then you want to look if you're over 70 and a half years old, not 72. Remember, that's the age for required minimum distributions. But if you're over 70 and a half, you want to look for a QCD, or qualified charitable distribution. Again, those are up markets. A down market, when you're in a period of deterioration or a market pullback where we are right now here in 2022, you want to look at it as a period of when I make a gift to my charity, I certainly never want to give anything that's at a loss, because if it's at a loss, I want to sell it, claim the capital loss on my own tax return. You may say, well, I don't have any capital gains to use. The IRS says you can still use a $3,000 capital loss every year, even if you have no capital gains. So if you're in the 25% tax bracket, that's like putting 750 tax dollars in your billfold. This makes all the sense in the world to do it. It's one of the reasons we use harvest tax loss strategies inside of the Financial Enhancement Group as well. Remember, you never want to give depreciated assets away to a charity. When you look at your family, your kids, people like that, who do you want to make gifts to? Well, when I make a gift, I have two daughters. When I make a gift to them and I'm dead, I'm gone, they get, under the current tax code, what's called a step-up in basis. So let's say I bought a stock at $10 a share. The stock is now worth $100 a share, and I die, and they inherit the stock. They're going to get a step-up in basis, meaning their tax basis is now $100 a share, right? So they can sell it, and they have no capital gains tax at all. It's free to them because I gave it to them at my demise. On the other hand, if I gave it to them while I was alive, their basis is my basis. So if I bought it at $10 a share and I gifted it to them for Christmas this year, then their basis is no longer $100. Their basis is now $10. Now, if they go and sell it, they're going to have to pay the taxes on the $90,000 in capital gains. Well, here's the interesting thing, parents. Many of us have tax brackets that are higher than our kids. I'm in that case. And so in my case, gifting them appreciated stock, selling it in their account, puts it taxable on their return, not on mine. And even though they had to pay taxes, it was still better off than me actually giving them cash. Now, these are some complex tax planning strategies. I'm not hiding anything from you, but I would tell you to work with your professional. Make sure you have somebody who is well-versed in tax planning and works well with your CPA. We believe in collaboration, not just cooperation. Right? Cooperation is when we call somebody and say, do this, and they do it. Collaboration is, what do you think about this? And we get the input back from your CPA or your attorney that we're working with to be able to come with stuff. So with charities, you always want to give appreciated stock. With kids, it depends on their tax bracket. Neither case do you want to give depreciated assets. You always want to put that on the highest tax bracket, the highest return. Even if you gift it to your kids at a capital loss, they can't use the capital loss. So don't be doing that at all. Here's one of the big ones that I think really gets people into trouble, and that's understanding what happens inside of a will, inside of a trust, and a tax-deferred plan. So inside of an IRA or a 401k, first of all of your assets that you have are includable in your gross estate. Under the current tax code, most of us don't have an estate tax problem. We have over $23 million in a married couple as a estate right now that they have that's free and clear. And there aren't a lot of $20 million estates that are running around. There are some, but for most of us, there's not an estate tax problem that is out there. So you don't have to worry about this right now. But you've got money in an IRA. Let's say we've got $1 million in an IRA, $1 million house and lake house combined, and $1 million in a brokerage account that you've saved and accumulated money. So you've got a $3 million estate. You've done well for yourselves. There, you have no estate tax implication. $3 million versus $23 million. No contest there, right? And you want to leave behind 10% to your charity. Well, it is very, very common for an attorney to tell you that you can create a trust and put your house and your lake house inside of the trust. That makes all the sense in the world, by the way. That keeps you out of probate, especially if the properties are in multiple states. I think it makes sense. Not an attorney. Don't play one on TV or radio. But that's the way, in my opinion, that it should be done as a non-attorney. Secondly, people will ask you how much money you want to give to charity. In many cases, in our practice, people say, well, 5% or 10%, sometimes even more, I want to leave behind the charity. Well, here's where the rub becomes. Money that's inside of your house or your brokerage account or your lake place, your kids, your heirs get a step up in basis on, meaning they're paying zero in tax. On the other hand, money that's inside of the IRA or the 401k, when you're gone, whoever inherits that will pay taxes unless they are a charity. So ideally, when you pass away, the money that you want to go to a charitable entity comes from the IRA or the 401k, not from money that you've already paid taxes on, where your heirs get a step up in basis so that they have literally zero taxation that's on there. Yet many times I see people who will come in and have the trust say, or the will say, I want to leave X amount of dollars to the church, or I want to leave X amount of dollars to this university. I would tell you always use a percentage, never use an amount. And if you have that in your trust, don't panic, but write a letter to the successor trustee that says, inside of the trust, says, hey, by the way, we've changed the beneficiary designation on our IRA. If this gift has been given out of the IRA to the charity, then do not give any money out of the trust. Just be very, very clear about what's going on. Ideally, you have it updated and changed in the trust, but that documentation going along with it should be enough to be able to suffice in case anybody has any questions. So let's think about this again. We've got a stock. We paid $10 for it. It's now worth $100, right? If we're going to give it to charity and we're able to itemize, we get a tax gift of $100 on our tax return. We do not ever have to pay the taxes on the $90. If we give it to our kids while we're alive, the kids' tax basis is $10. If they were to sell it, they have to pay a capital gains tax of $90 per share. That could be okay if they're in a lower bracket. If you're in the 12% bracket or lower, currently there is no capital gains taxation. And then the third option is the stock we paid $100 and it's now worth $10. You never want to give that to a charity. Anytime there's a loss from what you paid, you actually want to sell it, recognize the capital loss so that you have it on your return, and then make the gift of the cash if that is what you're going to do. Remember, none of that matters inside of an IRA or a 401k. That is just after-tax money. This is a great period of time, in my opinion, to make contributions to your retirement account, to your 401k account, but not to accelerate charitable gifting. That doesn't mean you don't give. I just wouldn't accelerate it this year unless there's definite tax purposes. It's a year to accelerate your contributions to your retirement accounts. Let the market do its work. You've got $1 and you want to leave it behind, not to your kids, but to a charity, to a church, to a university. How do you do it? You've got money in an IRA, you've got money in your house, you've got money in a checking account. Which one do you give to the charity? The answer will almost always be the money inside of the IRA. Almost always. Find out more from the Financial Enhancement Group. Give us a call at 800-928-4001 or go to yourlifeafterwork.com. We'll walk you through the Better Giver. That's our program designed for charitable giving. We don't necessarily teach people how to give more. We just teach you how to give more effectively, more efficiently. Again, yourlifeafterwork.com or give us a call at 800-928-4001. Welcome to Your Retirement Playbook. I'm your host, Joe Clark. The title of this segment, this one part, is Beginning Distribution in a Deteriorating Market. The theme for the whole show, if you've missed it, is really what to do now. There's craziness that's going on that abounds. Yikes is what may come to mind when you open up a statement. There's not a news channel or a newspaper that gives me one iota of confidence in our financial future. You may ask yourself the question, how do I possibly make decisions without any clarity at all? And they're honest questions. They're legitimate questions. I think we have to recognize we are in less control by far than we believe we are. When things go in the direction that we want them to go, we presume we have more control over the outcome. When things go distantly from what we'd hoped, the inverse of what we'd prayed for, we think we have less and less control and the world is lost. The reality is it's somewhere in the middle. We don't have that control over many things. What we do have the capacity to control is how we respond to certain things. So years ago when I got into this industry, the idea, and if you're not watching this on YouTube, you can always watch the video at Your Retirement Playbook. It's a freebie. We do it on the video, so you're not seeing the whiteboard if you're listening on the radio or the podcast. But when we looked at this, when I got into the industry in 1987, what I was taught is people had a percentage of their money in portfolios. Let's say it was 60% equity and 40% fixed income, right? What you hear about the 60-40 portfolio. And then they would take that amount of money and they would live off of the coupons that came out of here, out of the bonds. So remember, bonds are taxed like interest, but they don't pay interest. Bonds pay coupons. It's important to understand that if you ever want to get the value correctly. But people lived off of these coupons, which was very tax inefficient. You've got to remember, I've done this for so long that when I got in the industry, the majority of the money was not in 401ks and 403bs. It was pensions, Social Security, and money that people had outside of IRAs and 401ks. And they would live on these coupons and let the equity market continue to roll. And whatever they didn't spend here, they would put up here, or when the market went up and this became worth more, they would pull money down here and buy more bonds. And that was just that constant game of going on. It had no tax consideration at all. Well, let's face it. I've always said I hate the IRS. That's not really true. I hate what lack of tax planning does for people's retirement. I think it's the biggest thing that is missed and overlooked, and I've never seen anything like the Internal Revenue Service separate somebody from the retirement they deserve. I just never have. You deserve the retirement that you earned, and I mean that. You know, we've talked about this before. It's a Zig Ziglar comment. Everybody pays a price. You either pay the price of discipline today or the price of regret later on. You either say no to going to Disney today, no to buying a newer car, no to buying a bigger house, and have a better retirement, or you buy the bigger house, you buy the nicer car, you go to Disney whenever you want, and you have the regret for retirement later on. Somewhere in the middle is where we have to meet. You can't say no to all of the fun stuff of life. That's not any good. But you can't say yes to everything either. You won't have a future, right? So it's that compromise that's inside and in between. Well, the IRS is the neutral system. I'm not abdicating that person does a 60-40 portfolio by any stretch of the imagination. I would disagree with any number in a fixed setting or a static system in a changing and volatile market. What I created years and years ago was called the funnel solution system, though, and it was very much based on taxes. And it essentially said when you get into a volatile period of time, you have cash that's down here that's going to take care of the next 3 to 6 months worth of your income needs. The more volatile, the more that number needs to grow. The less volatile, the more it can be moved toward 3 months. I don't think you should ever have less than 3 months of accessible cash in any market because you never know where market's going to play, what's going to happen in short-term volatility. Go to the fiduciary focus. Rule 1 is risk and volatility. Let's eliminate the need for volatility so we live out of cash. This minimum side is income-producing investments. And notice I didn't just say bonds. There's a lot of things, real estate investment trusts, things of that nature, that produce income. That income is here. Ideally, money that's inside of IRAs produces more income because then it doesn't show up in your tax return. Money that's outside of IRAs produces less. But it's a combination of the two working together. And up at the top are your equity and growth machines, if you will. As markets change, this money flows down, this money flows down. As more opportunity extends itself, we may increase the equity percentage slightly and decrease the income production using capital gains as opposed to ordinary income as our tax liability, right? So it's a combination of the thing. What I want you to take away from this is that the days of clipping coupons are over, have been over for an extended period of time. You've got to have a comprehensive tax planning guidance in terms of where money comes from, what percentage of your money you're pulling out from where. In most cases, in our families, it's not money from one place, it's money from multiple places. Secondly, I believe in the 3-year examination rule. So when somebody comes in and says, how much money can I take? I'm getting ready to retire, I've got $1 million or $1.8 million. That seems to be an average and I'm seeing a lot of anymore. Somebody comes in and they got $1.8 million and they said, how much money can I take? And I will always go, okay, first question isn't how much can you take? The first question is how much do you need for your standard of living? How much do I need to replace your standard of living so that not 1 ounce of your life changes the day you quit, other than you no longer have to get up to an alarm clock if you don't want to, and you don't have to go to work if you don't want to. And so we come up with that number. That's going to be a certain percentage of their assets, likely. In some cases, it's a very small percentage. In some cases, it's a higher percentage, but we need to know that number. How much do you need to replace your standard of living? Secondly, we're going to help them develop the best strategy to be able to pull that out of. Which accounts from the tax planning side does that need to come out of, and what percentage do we need to get in order to attain that objective? That'll tell us the percentages that belong inside of this process. Now, we don't call it the funnel solution system anymore. Internally, we call it FSS 2.0. But this is the process that we've always used, and it really, really makes sense for a lot of different reasons. But you've got the percentage that you need to take out. The tax planning is put into order in terms of where it can be able to go. And we say, here's your income. Now you have something like 2000 occur with a tech wreck, or 2008 and 9, or the pandemic in 2020, or something bad happens, and the market goes down in value, and people will go, oh, right, I need to change my income. Well, if you've got this built up correctly, yes, this may be a larger percentage now of your portfolio simply because the equity went down, but you're still okay. It gives it time to work its way out. And what I've seen is over the course of 3 years in my 35-year career, which is probably longer than your serious retirement saving days, it's always worked out. Whether it was 87, the tech wreck, as long as you had a diversified portfolio, you were attentive toward tax planning, you understood what was going on, our strategy has been able to work out where retirement plans really hadn't need to be changed. Even in 2008 and 2009, as long as you followed that, you were in good order. Now, people tend to get caught in risk, right? The fiduciary focus, risk and volatility. They get caught up in risk, principal risk. That's the value of something going down and not coming back. And that's typically not what happens. That's volatility. Risk is it coming down and not getting your money back, right? And that's principal risk. And we put such a large emphasis on it that people really change their lives for reasons that they don't need to. If you had the money in the cash and you had a proper income generator in the middle, you really wound up being okay and not having to make those changes. Don't just get caught up in this day and age just on principal risk. Don't get caught up just on interest rate risk. You know, it's exciting right now to see interest rates higher. It's bad for people that are having to get mortgages, but it's exciting for people that are wanting higher interest rates. Just understand inflation is greater than both, right? The inflation rate right now is higher than what the savings rate is. That means you have a guaranteed loss of purchasing power into the future. Inflation and purchasing power is just the one that we hit. Market risk is obviously the market going down and money not being there when you can get it. Credit risk is a bond having its risk lowered and the value on paper changing, even though it may mature at the same value that you bought it. Business default, we all know about. That's when a company goes under. Those are the ones you tend to hear about on the news. Ladies and gentlemen, there's many, many different risks to money. What's important is not just a diversified portfolio in terms of assets, but what's important is a diversified portfolio based on tax planning. It's the 3 phases of finance: accumulation, preservation, distribution. It's understanding the objectives in each of those 3 and making sure that you have laid out a strategy that lets you deal with changes that will occur. There is no way around it. right? There are going to be hiccups. There are going to be things that go bump in the night. But you can choose to react to them emotionally, or you can choose to have a response put together. It'd be great to be able to predict all of the things that are going to occur. But as I've told my friends on many cases, if I told you it was going to be the day before the crash in '87, would you have invested or not invested? And their answer is not invested. And my answer has always been, how long until you have to use the money? Because you would clearly have invested today everything that you have if you knew from 1987 to 2022 what the market was going to do. You can do the same thing for the tech wreck, for 2008 and 2009. Long term, the market tends to behave. Short term, you have to deal with not just the volatility of the market, but the volatility of your emotions. Let us help you at the Financial Enhancement Group eliminate the volatility of your retirement. When you go to separate from the workforce, let us help you create a system that says, here's the income. You deserve the retirement that you earned. You made decisions. You made choices. Let us help you carry that over to the finish line and make sure that those decisions match up with what you earned. You deserve the retirement you worked for. What to do now? That's been the question. I'm Joe Clark, your host. I'm a certified financial planner, the managing partner of the Financial Enhancement Group. We take care of more than $600 million for more than 30 families in 30 states, more than 1,100 families. It's an honor and it's a privilege to be able to do what I love to do. I use this show as an educational format to try to give you things to consider, things that you need to understand in this changing and crazy world that we live in. But you know, the interesting thing is I've done this for 35 years. I don't remember a period of time where it hasn't been crazy and changing. See, I think we get caught into looking at very, very small parts of life instead of looking at the overall picture. And the overall picture is a constantly changing and developing landscape. To say that our economy is anything less than fluid is probably not to understand what is going on. The dynamics of what exists politically, financially, tax code-wise, the global world that we live in, what's going on with commodity prices right now, the currency issues that are there. All of these issues come together to create what it becomes your retirement reality, right? So our job is to help you with your life after work. It's our job to put together content for this show to give you educational understanding of things you need to consider and what it is that we consider inside of the Financial Enhancement Group. Now, if you want to do this on your own, God bless, I hope you got a lot out of this show. But if you're looking for a fiduciary, that is our business. And we would just ask that you would give us a call at 800-928-4001 or go to yourlifeafterwork.com. Get signed up for your next steps meeting. You're going to assemble your tax return, you bring it in, your investment statements, understand what's going on. You're going to come in and you're going to sit down with somebody on our advisory team, and we're going to give you 90 minutes of our best thoughts. 90 minutes of what it is you need to consider today based on your personal situation, what you're going to want to consider tomorrow, and what you're going to need to consider into the future. And we'll put it into writing if FEG and you determine that this is a right fit. You guys partner together. We'll take all of that and give you that information so that you have a better understanding of your retirement today and tomorrow in terms of where it's going. Ladies and gentlemen, you're on a financial journey. Do not let a short-term period of time provide overconfidence or over fear. Let's get it right. You only get one shot at retirement. yourlifeafterwork.com.